Welcome back. And we're joined by Rishi Anand, MD and CEO at Aadhaar Housing Finance from the sidelines of the IIFL Conference that's at play. Rishi, great chatting with you. Of course, it's event-based given that you're at the IIFL conference. Talk to us first off about what are the key concerns that investors as well as people you're speaking with at the conference, analysts, investors, are asking you about, where housing finance sector as a whole in India is concerned. Let's start with that.
Okay, Harsh, good morning, and it's always a pleasure speaking to you. I would say no serious concerns with regards to the industry as a whole. There have been questions around what does the growth trajectory look like, how is the next financial year looking like, how is the current quarter looking like. I think what the overall investors are trying to gauge is there a growth story in housing finance as a whole and specific to the low-income housing finance sector that I represent. And they derive a lot of comfort out of the numbers and the last 3 quarters numbers that we posted. I think overall it looks good and they are kind of satisfied.
Rishi, we've had a couple of blips where housing finance is concerned. You've seen some asset quality issues in 1 or 2 pockets. What's keeping you insulated and very, very confident? Because recently you met with analysts and you guided for a credit cost of around 25 to 27 bips over the next 3 to 5 years. In fact, steady state, that's the goal. What's keeping you confident with regard to that when you have some of these blips in the sector as a whole?
So you're right, Harsh. I have guided, while today we sit at a comfortable credit cost of 23 bips, I've guided for home loans about 25 bips, non-housing about 27 bips, and that too over the next couple of years. What is safeguarded us is, our strategy of not overexposing ourselves or concentrating in one particular state. Today we proudly say that on the top 3 parameters, whether it is AUM, disbursement or distribution, we should not be overexposed greater than 15% in any state. And you're right, a couple of states have seen blips with regards to asset quality. We get insulated because our exposure is less than 1% in that particular city, which has been a talk of the town. So that's the strategy which is helping us, Harsh.
Point taken. And this 20 to 22% growth rate, it's slightly lower from what we've traditionally seen you grow at. Is size catching up? Is that what is playing out? Are you being a little more cautious in this environment? What is it that's keeping you on the 20 to 22% kind of growth clip?
So Harsh, if you look at our trajectory for the last 3 years, those are the numbers we're talking about. We've always spoken about 20 to 22%, and we stand by it as we speak today, even for the current financial year, even for the next financial year. I think size catching up is going to happen after that. Right now we should be closing the year at about 30,000 crores, and the aim is to double our book from here in the next 3 years. I think when we hit the next financial year, post that, on a higher base, then the trajectory might be 18 to 20%, which will be a substantial number also.
And Rishi, you're very well capitalized. So essentially margins isn't probably the best way to look at you. It's the spreads. And therefore, when you're looking at maybe a 5.6% kind of spread number at the very base, what's the risk of maybe you breaching that 5.6%, which is your guided range? Of course, you're doing better than that, but your guidance is 5.6%. Is higher competition coming in? That could likely be a risk in your opinion, or you're very comfortable with that 5.6%?
So Harsh, you're right. We're today standing at a higher spread of about 6%. The guidance that we've given is that over a trajectory of the next 3 years, maybe every year will drop about 7 to 8 bips. So that's the trajectory, and always maintained, and we still maintain the fact that we will always be a company upward of 5.5, 5.6% spreads. I don't see any reason why whether competition or anything else is going to pull us down. I think it is the incremental yields that are coming in today are 40% below the book yields. I think that is going to catch up over the period of next 3 to 4 years, and it's going to stabilize at about 5.5, 5.6 spread over the next 3 years.
And therefore, Rishi, as capital adequacy for you gets thinner, I mean, you're at 40% plus. So don't see that at least over the next year, but maybe over the next 3 years as capital adequacy shrinks. What keeps you confident with regard to ROA trajectory? My understanding is it's a couple of pieces. One is, of course, your spread, but the other piece is also with regard to OPEX efficiency that will start to kick through, or rather that continues to kick through. I'm trying to understand, and probably I ask you this every time we meet, what keeps you that confident that you can do 4.5% kind of ROAs? Does OPEX shift materially lower, maybe say 3 years from now versus where you are at?
So yes, Harsh, you're right. ROA will be a combination of multiple factors, OPEX, spreads. The way if you look at our numbers for the last 3 years, OPEX to assets have been dropping by 7 to 8 bips, and I don't see a reason why we can't continue our journey with a lot of these technology interventions, AI interventions kicking in. Our branch strategy, for example, and when we say we are going to be expanding 50-55 branches every year, these are low cost branches. We typically break even in about 8 to 9 months. That's the kind of setup that we've created across tier 2 and tier 3 cities. So I think it is also to do with how you internally move around the small pieces. And as I indicated, 7-8 bips drop in OPEX is a continued journey. So that's going to help retain our ROAs upward of, if not 4.4, which is where we are today, and upward of 4.2.
Is there scope for deeper penetration? I mean, you've guided for branch count to be at around 750, which is you expand by 50 branches every year. I'm trying to understand this 25% branch count growth. That means your vintage, which is your older branches, will likely contribute disproportionately to AUM growth. Is that how you're starting to pencil things in?
So you're right, Harsh. Whatever, let's say, and maybe illustratively today I opened about 50 branches in the current financial year. That's going to be start to give me numbers and ROAs and OPEX next year onwards. So there is always a lag of 12 months. So whatever I opened last year is going to start giving me results this year. Your first question on, is there a scope or deeper impact? Yes, there is. Today we in the deeper impact strategy that the company has adopted, we've gone to emerging C locations, which is typically tier 4, tier 5 locations. These are small talukas and district centers, and we've just reached about 200 of them. So there is huge scope. We've just targeted for now 5 top states, and then we are available in 20 total about 22 states. So there is a huge leg room to work upon.
When does the next fundraise really kick in? Is it FY29 or beyond FY29 when you hit 60,000 crore? Is that the right way to look at things? So therefore, no equity dilution till that point?
Partially right, I would say, Harsh. Your judgment is always right. When we become double the size today, we work on a lever of sub 3% today, and the way the market comforts at about 5.5, 6%. So we have huge leg room, and by those mathematics, maybe 29, 30 once we reach double the size of what we are today. So 60,000 crore, yes.
Anything that can upset the apple cart, Rishi? Any conversations you've had as part of this conference where certain risks could maybe low in probability, but could translate?
So Harsh, BAU issues, they continue, they keep coming in on a daily basis. You keep resolving them. That is BAU. I don't see any big ticket item which is going to be upsetting the apple cart. That is, if I can come in here and say that there is a little too much that is happening on the supply side and the demand side by the both central government, by the regulators. So that there is sufficient happening there. I think people like us will have to be foot on the ground, have your branches up right and at the right places. That's going to work. What may upset you is something called employee attrition, book attrition. But if your matrices, your control mechanisms are in control, even those don't upset you.
Rishi, where does your cost to income bottom? Let me first kind of give viewers the trajectory. You were at 38% FY24, fell to 37, fallen to 35 now, or closer to 35 FY26. Where does it bottom? Because Now, increasingly, the base on that is coming, or rather is going to start to, kind of pressure you. So I'm trying to understand whether that lever gets exhausted maybe 2 years from now, 3 years from now, and at what level?
So Harsh, you're right. The kind of company we are, the kind of consumers that we cater to, you have to branch out. It's a high OpEx model. Everything is done in-house, right from sourcing to underwriting to property evaluation to collection. Everything is in-house. We don't outsource anything, which means, foot soldiers are higher in numbers. And when you branch out about 650 branches as we stand today and expanding thereon, OpEx will be high. And you're right, we've dropped from about 38% to closer to 35% today. I think there is little more room for about 50 bips drop for the next, I would say, 2 to 3 years. And that's where we are going to be stabilizing.
Very quickly, Rishi, any scope for ROE expansion from here, or you'll steady state be 17% and really that's the target, maybe 16 to 17% plus minus 50 bips?
So Harsh, today we are about 15.8 ROE. A couple of years down the line, the way we look at our organization, 4.2 ROA, closer to 17.5% ROE. That's where the company should be comfortably positioned.
Okay. Rishi, thank you so much for coming in and speaking with us, and hope you have a great day.
As always, thank you.
And viewers, what we'll do is slip into another very short break. We'll continue coverage on the other side. Stay with us.